Hello everyone, my name is Srikar Susarla and welcome back to my channel. So this is the third video of the series Retire Early Not From Work But From Stress. So in the earlier videos we had discussed about goal setting and securing our path via insurance. So in this video we will be discussing about various kinds of investment instruments which will help us retire early. So we need to park our money somewhere which will generate more return than inflation and can get us rich sooner than expected. We should know our risk taking capabilities before we know about different kind of investments, so that we can, when the time comes, we will be able to know whether that particular instrument is a right fit for us at that particular moment or not. So to know the risk profile, I have attached a link in the description where you can go to the link and you can submit answers to the questionnaires given, and it might take 5 minutes of your time, but these 5 minutes would be very helpful for you. And at the end of the test you will be given a risk profile table where your score will be given and the kind of risk you should be taking would be given. This might not be like sure shot, but you will be knowing what is the risk taking capability of yours, and I hope you answer the questions genuinely. My score was around 29, which is like a bit medium to high tolerance for taking risk. Let me know your risk score in the comments. Now that we have calculated our risk profile, be it conservative, moderate or aggressive, depending on our risk profile, we should be able to invest in different instruments. Let's discuss each of the instruments one by one. The first kind of instrument which we are going to discuss is fixed deposit. So what is fixed deposit? So normally when we save some money in the savings account, we get nominal interest of like 3% or 4%. That's because the bank does not have any guarantee when you would be withdrawing that amount. So when you assure the bank that you will not withdraw your money at least for a year or two, the bank would be ready to give you the interest for a bit higher amount than the normal it would be giving. So in general, if the banks are giving like 3 to 4% on a savings account, the bank would be giving around like 5% or 6% for a fixed deposit. The next instrument is post office schemes. So this is also similar to a fixed deposit, but instead a government backed post office would be giving some certificate to you stating that they would be providing X percentage of return every year for the amount you save for like 5 years, 6 years or 7 years. Next is public provident fund. So PPF is similar to PF but without any limits. Normally PF carries 10% limit of our basic salary, but PPF has no limits. So it gives guaranteed returns which is determined by the central government of India every year, and it has a minimum lock-in period of 15 years and is also eligible for ATC deduction for our tax purposes. Next is NPS, National Pension Scheme. So it is a government backed scheme to provide security to senior citizens. There are again two tiers there are two. Next is NPS, National Pension Scheme. So this is a government backed scheme to provide security to senior citizens. Internally it has two categories, tier 1 and tier 2, where tier 1 is for retirement account savings and tier 2 is for voluntary savings. Tier 1 provides tax benefits as well, but you can withdraw your amount only after you attain retirement. For tier 2 there is no tax benefit, but you can withdraw your amount at any given time. And the tier 1 account also gives additional benefit above the ATC limit which we have for 1.5 lakhs. It comes under ATCCD where the limit is 50,000. So overall with ATC and ATCCD you can gain like 2 lakhs. Next is SGB, Sovereign Gold Bond. So it is a contract between us and the government where we would be locking in our money for 8 years for some X percentage of interest every year, which will be determined by the government, and at the end of 8 years we would be given tax free amount which is equal to the amount of gold at that point of time. So this is the interest earned in SGB is taxable as well, and we should be showing it in other income from other sources category. Next is real estate. Be it personal or commercial, real estate is one of the oldest kind of investment instruments we have. So in this instrument we buy a property or a flat and either stay in it or rent in it, and the land or the flat value appreciates over given period of time. So many of us think that buying a personal flat might be a investment in real estate, but it could be more like a personal emotional decision but not a financial sound decision, and we can discuss more about this topic in a separate video altogether. Next is REITs, real estate investment trusts. So buying a property in a prime location as a whole unit would be difficult for many of us, as its price would be around 80 to 90 lakhs or even more than 1 crore. So in order to be able to enjoy that return which that prime location gives, these REITs company would be owning certain lands in prime areas and would be constructing building and leasing it to other companies. So you might have heard about IT parks, right? So those are owned by these REITs who would be constructing a building and would be leasing each floor or the entire building to another company for longer period of time, and would be giving the return to the customers which have purchased their shares. Next is bonds. So bonds is similar to a fixed deposit, but instead of having a contract between you and the bank, you would be having between you and another player like a government or a company, and you would be giving them certain amount and they will be assuring you with certain amount of return every year, and once the tenure is over they will be returning you back the principal amount. These are all taxed. Next is equities or stock markets. So in this kind of instrument you purchase a stock which is a part of a company, and with that you become a owner of that company, and you get to earn in two ways: with the appreciation of a stock price and also with the dividend which the company provides every quarter or year. So it is similar to real estate where you can earn in two ways, right? There is a capital appreciation of the property and also the rental yield of the property. So similarly in stock as well, you can get the dividend yield and also the capital appreciation as well. We should be aware of the risk while investing in the stock markets, as there is a chance of losing the entire capital. So we should be diversifying our portfolio based on our risk profile. Next is farmlands. Though it is difficult to buy a huge farmland in range of half acre or 1 acre by an individual, now it has been made easy by owning small unit of a particular farm plot. So there are certain companies which provide this, and in return they give yearly yield of around 5 to 10%, which would be tax free as it is an income from agriculture source. Next is peer-to-peer lending. So imagine a scenario where you do not have any credit card and you have not any eligibility to get a personal loan, but you are in need of an urgent cash. So what would you be doing? You would be going to a local pawn shop and you would be giving your gold in exchange for money and for high interest rates, or even signing a contract without any collateral and you would be getting it for high interest rate. So that concept is now regularized by government and in the form of P2P lending, where this platform gathers lenders and borrowers, and they would be charging some commission to provide that service, and the lenders can get money by lending the amount to the borrowers, and in return the borrowers will give the money, and for all this process the P2P platform would be taking some commission. So as you can see, this might be very risky, so you should be able to divide your amount into different small chunks, and you should be able to place your amount to give your amount to many different people on the P2P platform, so that you do not lose your capital. Next is cryptocurrency. It is a digital or virtual currency which operates independently of a central bank. The governments do not regulate it currently, but they are planning to regulate it maybe soon enough. But they have currently taxed cryptocurrencies in India at least 30% on the gains, and there are like various instruments in cryptocurrencies as well. Apart from price appreciation and yield, There are many different concepts which we can discuss in the later parts of the videos. In conclusion, we have various kinds of investment instruments available in the market, and we should be able to choose the perfect instrument depending upon our financial needs, time horizon, and risk profile as well. And remember that investing is a long-term game. We should be able to diversify our portfolio and stay disciplined until we achieve our goals. I tried to cover as many investment instruments as possible, and if you think I missed any of the instruments, you can comment them in the comment section, and also share this video among your friends if you think this video was very helpful, and see you in the next video. Bye.